concerned that the company produces a profit and increases their wealth. Creditors want to know that the company is liquid enough to make debt payments, and they want to know the solvency, to know if the company is solvent enough to repay the loan. That's the principal and the interest. Oh, I'm going back. Managers want to be compensated for their work and have confidence that their employer will provide job security. Customers and suppliers want to benefit from the ongoing business relationship. The government also wants to ensure that public good by collecting taxes and improving financial reporting. So all these stakeholders can benefit and achieve their objective if they have good financial information. And they are saying that what don't financial statements tell us? We have established the fact that financial statements are one way to tell how the company is doing financially. So how come there are scandals, accounting scandals, the Enron, the world with the WorldCom and all that? And in Ghana, 2017, there was financial scams where UT banks and some other banks were closed due to issues regarding their financial statements, and it led to the consolidation of 5 banks in 2018. And this has brought us or ignited our interest in what these statements are not telling us. So these companies have been providing financial statements, and mostly these things tell us that these companies are doing well. So why is it that all of a sudden these banks have to be closed? So meaning there was something they were not telling us. So in particular, the focus has shifted to companies off-balance sheet liabilities. So when we say off-balance sheet financing, they are methods used to finance a company without showing debt on the face of the statement of financial position. So fortunately, there has been a significant development in accounting principles where many of the formerly off-balance sheet liabilities are to be included in the notes of the financial statements. You remember the types of financial statements we spoke about earlier on. So that's one way to ensure that most of the things are being included in the financial statements. What do you have to look for in financial disclosures? So in the financial disclosures, you have to look at auditor's reports. The auditor's reports will give a lack of going concern qualification is the death strike of company. So the auditor's report will let us see whether the company is doing well financially. Are they a going concern, or there's something that can lead to the dissolution of the company? Write off or write down of assets. What does this imply for future earnings? Write down of inventory. If they write it down, what does it mean about their decision to build it up? What will this do to future earnings when they sell these goods? And then what to look out for in the footnote. So the footnote, the company sometimes states the new accounting standard they are to adopt. Related parties transactions shifting from receivables to or from subsidiary, reducing in line of credit. Changes in assumption for employee benefit, changes in depreciation lives or salvage values or method of charging depreciation, and contingent liabilities and provisional. So all these are things that you will see included in the footnote of the financial statement. And then what do we look out for when comparing year-to-year changes and overall trend? So with this, you have to look at the change in the accounting method. Maybe the changes are due to changes in accounting methods, substantial increase in deferred revenue. Please, can you hear me? And are you following?
Yes, madam.
Yes. Yes.
Okay, we are looking at the items you are supposed to see in the financial statement. That's why I'm pointing them out. Increase in valuation allowance, cash flow from operations, that is increasing or decreasing at a rate different from that of net income. Falling reserves for bad debt and account receivables. So financial statements. So as we established earlier, IAS 1 posits that financial statements are structured representation of the financial position and financial performance of the entity. And the objective is to provide information about the financial position, performance, cash flows that is useful to a wide range of stakeholders to make economic decisions. Financial statements also show the results of the management stewardship of the resources entrusted to them. They want to see how the financial statement, the results will show whether management is doing well or not. So we talked about the components of the financial statement. Then, so a statement of financial position, comprehensive income for the period, a changes of a statement of changes in equity for the period, a statement of cash flows for the period, notes comprising a summary of significant accounting policies and other explanatory information. And then we have a statement of financial position as at the beginning of the earliest comparative period when an entity applies an accounting policies retrospectively or makes a retrospective restatement of items in its financial statement, or when it reclassifies items in its financial statement. So financial statements are prepared for presenting a periodical review of reports on the process by the management and deal with the status of investment in the business and the results achieved during the period under review. So annual reports is a non-financial statement. It tells the status of investment in the business and the results achieved during the period under review. Annual reports, on the other hand, contain both the financial statements and non-financial statements of the company. The non-financial statements that can be found in the annual report are auditor's reports, management reports, director's reports, corporate social responsibility reports, value-added reports, and it contains lists of major shareholders of the company. So we have looked at the difference between financial statements and annual reports. So financial statements includes all these statements, the ones I've just mentioned. And then annual reports is made up of both financial statements and non-financial statements. And we have the various reports included in there. The annual report also provides vital information about board of directors of the company, auditors, and company secretary. It also discusses or presents information that can be described as voluntary and others, especially the financial statements, as mandatory. The chief executives and board chairman's statements are also part of the non-financial and voluntary. The cover page to the main contents of the annual report are all very useful sets of information to the public, competitors, investors, employees, and researchers, among others. Any question? Hey, the ladies are not talking. Have ladies here.
Madam, you are talking. Madam, you are talking.
You don't have ladies here.
We are here. Oh, we are here.
Yes, so I know you are using one laptop as a group. So mention your name. I know Ernestina. Ernestina Crash has not spoken. I know Jennifer. Jennifer.
Madam.
Jennifer, do you understand what I've been saying?
Yes, madam.
So I can ask you a question.
Yes, but she said you can answer the question.
Jennifer, what's the difference between a financial statement and an annual report? Jennifer.
No, I'm not.
Jennifer.
What?
Madam.
You are the only lady I know here, so I'll be mentioning your name. What's the difference between financial statement and annual reports?
Madam, annual report comprises of both financial statements and non-financial statements of the company.
Okay.
And financial
Madam,
statements.
Hello.
Madam, she's not done.
I am listening to her.
Madam, and financial statement is a collection of unorganized data, which consists of accounting procedures.
Are you reading from the book?
No, madam.
I want your perspective on the issue. Hello. Is there any other lady there?
Yes, yes. Anna.
Jennifer, thank you. So Jennifer, Anna, please help us.
Okay, Madam, I'm Annie.
Annie.
Please, financial statement
Annie, yes.
consists of a statement of financial position as at the end of the period, comprehensive income for the period, changes of equity for the period, cash flow, and many others, please.
So what is the essence of all these things? What does it show us? What does it tell us?
Hello, madam.
Yes.
Hello, madam.
Yes, I'm here.
She's done with the financial statement.
I'm listening to Annie.
Please.
Madam, she's done.
Oh. She was mentioning the items in the financial statement, and I'm saying that what does all these items tell us? Who help her?
Madam, it shows the financial position of the organization within a period.
Please, who is speaking?
Annie, please.
Hey, the same Annie. Okay, Annie, thank you.
You are welcome.
Madam, Bennett.
Okay, so according to hello.
Madam.
So according to AICPA, this statement reflects a combination of recorded facts, accounting convention, personal judgment, and then the judgment and conventions applied affect them materially. What is AICPA?
American Institute of Chartered Public Accountants.
Hey, who is speaking?
Madam, please. Ernest.
Ernest. So
Eric.
Ernest, you give me your name. Eric.
Eric,
Is it
Madam.
Eric, talk.
Is it Eric or Ernest?
Ernest.
Eric and Ernest.
So who just spoke?
It's
Ernest.
Ernest.
Okay. Ernest, please come again.
Madam, please, what do you ask?
Oh, you are not the one. What's the meaning
Madam,
of AIC?
one. I said American Institute of Certified Public Accountants.
Okay. Thank you. Ernest, right? Ernest Isel. Anane. From
Yes.
Bumpton.
Yes, madam.
Full name.
I thought we have one study center here. Oh,
Yes, madam.
I'm not talking.
No, please. No, madam.
Nobody from WA has spoken today. It's only the Bumper people. Yes, Sule.
Madam, please, I'm Ibrahim from
Family
Center.
center is there.
We have Tamale Center here.
Madam, please, I'm sorry, yeah, family center is there.
So you are from Tamale Center. Sule sorry,
Yes.
sorry.
Please,
Sule.
madam. Don't mind Joseph. That's what Joseph dear.
Yes.
If Joseph talk, we will close today. Don't mind Joseph.
And then we have WA Study Center.
Yes, madam.
Okay, so we have Tamale, WA, and Bumper. And which center haven't I mentioned? Ibrahim,
Yes, madam.
please, which study center are you from?
Madam, please, I'm from WA Center.
And you've not spoken today. You tell me something. What have you learned so far, Ibrahim?
Madam, please, I just joined, but
You
so
just
far-
joined.
yes, but so far, as I follow the distance, no, I realize you explain the differences between the financial statement and annual corporate
Annual
statement.
report.
Yes, annual report.
So what did you gather from there?
Yes, madam, what I realize is that from your explanation and what I learned, I realized
Okay.
that the financial statements just the it shows the financial performance of an entity.
Okay.
What was annual report represent both the financial and non-financial report of an entity.
Okay. So does that mean that financial statement is included in the annual report? Yes or
Yes.
no?
Yes, madam.
Okay. Okay. Thank you, Ibrahim. Joseph. Joseph,
As for Joseph, dear, let's go. I beg
his
you.
hand was up. Which study center? Which study center? Joseph. Hello. Let's proceed. He's not talking. So according to AICPA, this statement reflects a combination of recorded facts, accounting conventions, personal judgments and judgments, and then the judgments and the conventions applied affect the material. So according to this statement, the nature of financial statements are as follows. Please kindly mute yourself. You are distracting the class. Monica. These events that change the financial position, the events that change the financial position are recorded in the primary book or in the journal proper. What is generally referred to as book of prime entry or value books. So from these books, ledgers are prepared, and from there, the trial balance is prepared. Nashiru, can you mute yourself for me? Thank you. From these books, ledgers are prepared, and from there, the trial balance is prepared. So all the facts and figures recorded in these books and statements are called what? Recorded facts. Hello. The financial statements are prepared from these recorded facts, and many important unrecorded facts are not disclosed in the financial statement. So mostly recorded facts are those that are presented in financial statement. For example, efficiency of labor is important. Hey,
Please, Monica, Monica, please mute yourself for us. Thank you.
efficiency of labor is important but not shown in the financial statement. However, some unrecorded facts such as market value of investment, contingent liability are disclosed in brackets or in footnotes to make financial statements significant. So for the recorded facts, we have the recorded ones and the unrecorded ones. Mostly the recorded facts are the ones that are included in the financial statement. But if there is an unrecorded fact that is very important to the various stakeholders, the company then includes it in the notes. Hello.
Hi.
Then we move on to accounting conventions. So these conventions guide accountants in deciding how they record and present transactions in situations where no clear rule exists. So they help maintain uniformity and fairness in financial reporting. So they will guide you in how you are supposed to record and present things. Because of these facts, financial statements have the following features. So mostly data shown in financial statements are subject to the validity of the conventions used in their preparation. The same pattern of conventions should be followed by all concerns and the same industry for comparison purpose. So since most companies in the industry are using the same conventions, it's easier for an analyst or the various stakeholders of the company to do comparison. And in all, these principles aid in consistency and comparability. And then according to this statement, the nature of financial statement, we've spoken about recorded facts, accounting conventions, and then we are moving on to international financial reporting standards, which is commonly known as IFRS. So accounting is based on some accepted and running rules, assumption, ideas known as concepts and conventions. And I know you've all come across this. So IFRS includes concept, conventions, principles, which are used as standard for recording the financial transactions. So these financial statements are influenced by IFRS. Thus, closing inventory is valued at the lower of cost and net realizable value, followed by conservatism convention. So profit is measured by revenue minus cost, followed by the matching concept. Hello. And then we have personal judgment. So although there are conventions, IFRS that guide how statements are reported or presented, accountants mostly use their judgment. So although these aid in presenting their personal judgments affect how they go about things. So in some cases, accountants find a number of alternative solutions. So remember, there are a number of methods of calculating cost of industry. We have FIFO, LIFO, we have weighted average, and all that. But out of this method, one method is selected by the accountant on the basis of his opinion and his personal judgment. So in as much as these conventions and concepts are followed, the personal judgment or the discretion of the accountant comes to play. Then we move on to limitation of financial statements. So financial statements are prepared to present a periodic report on the financial position, which we've established over and over and over again. However, These statements suffer from limitation. So the first one is the interim nature. So financial statements are interim reports based on estimates and judgment. Income, expenses, and depreciation are allocated using estimated basis. Hence, the exact position is known only at the closure of the business. The figures are there, all right, you can get it and all this, but some of these figures we have is subject to fraudulent activity, and it might not be the actual figure. Sometimes you can only know the position of this when the company is closed or dissolved. So how do we solve it? Proper division of accounting periods and correct matching of capital or revenue, and then income and expenditure. Unrealistic account valuation. So assets are shown at historical cost, not as realizable or replacement values. Contingent and fictitious assets may be included so that true financial position is not disclosed. Remember, in as much as they are following principles and all that, they use their personal judgment, and they always want the company to look good in the eyes of the stakeholders. So these are some of the limitations associated with the financial statement. So to solve this particular limitation, periodic re-evaluation by competent valuers, writing off fictitious assets, and estimating contingent items based on experience need to be done. And then static nature. The statement of financial position shows the position at a particular moment only. So since the position changes continuously, there is scope for window dressing. So to solve this, you have to use competent and ethical accountants and regular valuation and disclosure of assets and liability. So you have to be checking them. I know most of you here are accountants. You have internal auditors and external auditors. So these are ways that owners of the business have put in place to see that the managers are working in the interests of the shareholders, and then the accountants are doing what is right and ethical. Dependence on accounting concepts and conventions. So financial statements are prepared using accounting concepts and conventions. We may not always be realistic, thereby affecting the true presentation of results. Balanced application of accounting concepts and selection of suitable conventions can help reduce the adverse effects of this limitation. Historical cost limitation. So financial statements are based on historical transactions, and past prices make them less useful for future pricing, especially during inflation. So here you have to there should be adoption of inflation or price leveling accounting. And then we have single year analysis limitation. 1 year's financial statement does not provide meaningful conclusion. So you can draw or make conclusion when you do comparative analysis, and that was one of the tools under financial analysis. So in solving this, you have to use comparative statements, do common size analysis or trend analysis. Lack of comparability. So different accounting methods used by firms in the same industry make comparisons difficult. So here, use of value-added analysis, quality control techniques, and human resource accounting. We also have exclusion of non-monetary factors. Only monetary information is recorded. Non-monetary factors such as labor efficiency, product quality, and human resources are not shown. So it makes it difficult to know how they are doing. So if they are doing well financially and the labor is not doing well, sometimes they can include fictitious values and all that. So that is a limitation of the financial statement. So the solution is the use of value-added analysis, quality control techniques, and then human resource accounting. Then we move on to what? Personal judgment. Financial statements, as we all know, are influenced by the personal judgment of accounting in areas of depreciation and inventory valuation. So they cannot be relied upon blindly. So compliance with accounting standards to ensure consistency and reliability can help reduce the effect of personal judgment. So most of the times when people are analyzing financial statements, they would want the annual report. Nashiru. Hello. Nashiru, his hand is it a lady or a guy? His hand is up. Nashiru.
Can you hear me, madam?
Yes, I can hear you.
Yes, and just to draw your attention that Botek Group is part since the beginning of the lecture.
Which center?
Botek.
Tech.
Yes, please. Botek. That's Upper East.
Okay. Okay. Oh,
We've been on since the beginning of the lecture.
you because you've not spoken, so you will ask a question or give a contribution. Nashiru. Hello. Please, can you hear me? Bosek. Hello. Who is also from Bosek?
We are many here.
We are many.
Monica is also from Bosek.
Yes, madam.
Can I get the full name?
Akurgu Monica.
No, your center.
Botek.
That is Botek. B-O-T.
Bolga. Okay.
Yes, Bolga.
Okay. Bosek. Okay, so Nashiru, any question or contribution? I know Monica too is here. Monica or Bashiru, any comments or any question or contribution? Monica.
Madam.
Yes. Any question or contribution? Are you following? So mostly what people do is that the financial analysts and the various stakeholders, when they want to know the actual standing of a company, they look at their financial statements, but then they get the non-financial statements from the annual reports, that's be it the auditor's reports, to see whether the company is doing well or not. Hello, any question? Any question? Please, are you following? Philip.
Madam, please, you are following.
Okay, Philip. I can see a Philip here. Monica. And then
Madam.
we have Monica, are you following?
Yes, madam.
Now I know your name, so I'll be mentioning your name.
Madam, we are many.
There are many there.
Yes, please. A full class.
So the whole class is using Monica's laptop.
Yes, madam.
I can see Joseph, Monica, and Nashiri.
Oh, okay. So I know Joseph too. So we've looked at the the nature and limitation of financial statements, we are moving on to the analysis and interpretation. We know what financial statements entails. We know what an annual report is. We know a financial statement can be found in the annual report. Hello. How do we analyze and interpret financial statements? So, financial statements, the analysis and interpretation of financial statements is a comprehensive and intelligent presentation of information that help interested parties for the judgment and decision making. It is the study of relationship among different financial data. As we've said over and over again, it helps identify the strength and the weakness of the company. And then we get financial data that can be used for forecasting as well as what? Budgeting. So analysis means proper arrangement of data and methodical classification of data given in financial statements and regrouped into their distinct and different component parts. Analysis involves the division of facts based on some definite plans, classifying them into classes based on certain conditions, and presenting them in the most convenient, simple, and understandable form. The figures given in the financial statement will not help unless they are put into a simplified form. So, with the interpretation, it means explaining the meaning and significance of the data so simplified in order to ensure that you can do comparison and examine the components for making conclusion about the profitability, efficiency, the soundness, and then the financial soundness of the business. It's really an art, and it involves many processes like arrangement, analysis, establishing relationship between available facts, and drawing conclusion on that basis. Interpretation and analysis are closely connected because you cannot interpret without analyzing. Interpretation without analysis is useless. So the data of financial statements are not uniform or homogeneous. So analysis is made for reclassified, rearranged financial statements to make relation between them. So interpretation is conclusion and representing of such arrangement to supply information to the interested parties. And we said earlier that one way to do them is through ratios. Comparative analysis, you can use them, you can break them down in simplified forms in percentages and all that so that it will make comparisons easy. Therefore, whenever the word analysis is used, it implies both what? Interpretations. Philip.
Yes, please.
Deliger. Del. Philip.
Yes.
What's the difference between analysis and interpretation? Hello, Philip. Del.
Yes, madam.
Can you give us the difference between analysis and interpretation? Or what you understand on analysis and interpretation? Hello. Patrick, can you hear me?
Yes, well, I can hear
It's
you.
my network or their network. Patrick,
Yes, madam.
is it from my end? Is my line breaking?
No, your line is okay.
Okay. So who can help me? Interpretation and analysis. Nashiru. Nashiru Al Hassan. Who helped me? Mumuni Emmanuel.
Yes, madam.
Ankara. Sir. You guys are not responding to me. I don't know whether it's deliberate or it's your network. Sansa Ankara. Sansa.
Yes, madam. Yes, I can hear you, madam.
From which center?
What center, please?
What center? So can you give us your view on interpretation and analysis? You were following, right?
No, I joined not quite long, please.
Hey, Sansa, you have been here since.
Hey, I serious.
It's serious. Well, what do you understand by analysis and interpretation? Who helps Sansa? Sule. 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 Hey, you people are not talking. If you don't talk, we'll not move on. Kwame Achia. Hello. Hello.
Hi, madam. We can hear you.
So why aren't you responding?
Madam, 1% I want to try.
You want to try? I'm listening.
1%.
So you can hear me, you are deliberately not responding. Ernest, I'm listening.
Whenever we talk about the interpretation, what I know is it involves breaking information into parts in order to examine or organize and understand its objectives.
What
But
type of information?
Is it financial information? Financial information.
We are talking about analysis and interpretation with regards to financial statement.
Yes. So we are talking about like, yes.
I'm listening.
So when it comes to the interpretation, it involves how you explain the meaning of the financial information to either creditors or investors. Ajay.
Okay. Any other person?
Madam.
Please, who is speaking? Patrick.
Yeah. Madam, financial analysis is the study of the relation of financial data, while the interpretation deals with the explanation of the meaning and the significance of the data itself.
Patrick.
Yes, madam.
Are you from one center? I want to be conversant with your centers. That's why I'm asking.
Bompe. Patrick is in Bompe.
Bompe. Okay. Please go on. We are listening.
I said analysis deals with the study of the relation of the financial data, while the interpretation is the explanation of the financial data.
But in my submission, I said something at the end. Who recalls what I said?
Interpretation means explaining the meaning and the significance of the data so simplified.
I get what you are saying. I'm saying that in my earlier submission, I said something about interpretation and analysis. Who got what I said? Patrick,
Madam,
thank you. Who got what I said? Albert.
Madam,
Yeah,
you
what did
said
I say?
analysis without interpretation is it's not something. I forget the latter part.
It's useless because analysis, you cannot do interpretation without analysis. What are you interpreting? Please, you get what I'm saying. What are you interpreting? Hello. So analysis and interpretation, they go hand in hand. Meaning most of you are not following. They go hand in hand. Thank you, Albert. From which center?
Fiasaman.
Fiasiman. Oh, we have Fiasiman too here. Okay.
Yes, madam.
Fiasiman. Accounting, right?
Yes, madam.
Okay, thank you.
Albert, where is Max?
Ernest. So types of analysis. Analysis can be grouped into 3 different types. So you can do analysis according to material use, according to method of operation, and according to what? Objectives. You can do analysis according to material use, method of operation, and then what? Objectives. When we say according to material use, the first item here is external analysis. So analysis of financial statements made by external persons who are not related to the accounting records of the concern and have to depend on published financial analysis is external analysis. Outsiders use only the figures of financial statements and other supplementary of the annual report to get an idea to take appropriate decision. This is made up of bank, money lenders, creditors, government agencies, and what? Prospective investors. And then we have internal analysis. This is analysis of financial statements made by internal persons who are related to the accounting records of the company from internal records and books. Is known as what? Internal analysis. And it is made by members of the company, such as the staff of finance and accounting, management, board of directors. And this is done to help management in addressing the profitability, solvency, and liquidity, and to indicate the reasons of weakness of the firm. So for analysis, we said earlier that we have 3 types of analysis. We have analysis according to material use, according to method of operation, and according to objectives. For according to material use, we have external analysis and internal analysis. External analysis is done by external persons, that the external people who have stake in the organization, that's external stakeholders. And then internal analysis are done by internal stakeholders or the internal persons to indicate, to know how the company is doing. Hello. The
Hi,
second
madam.
type,
We can hear you.
the second type of analysis is an according to method of operation. So financial analysis may be of 2 types. We have horizontal and vertical. So when we talk of horizontal analysis, it is when financial statements of 1 year of a particular organization are analyzed and interpreted and compared to another year or years. So when you take the financial statement of Farm Milk Ghana, you get financial statement for say 2020, 2023, and then 2025. You can analyze these statements and compare them to each other to see how the company is doing. And then we move on to vertical analysis. This is when financial statements of an organization for one period is analyzed. So it is for one company, it's vertical. Here, the items of the income statement are expressed as a percentage of either sales or total assets. And this analysis is useful for intra-firm comparison. So the vertical analysis is done within the company for that particular year, and then the horizontal analysis is done across years. Then we move on to analysis according to objectives. So financial statement analysis may be done through long-term analysis or short-term analysis. So when we talk about long-term analysis, this is made to study long-term financial stability, solvency, and profitability of a concern. This analysis helps to know whether the company will survive in the long run and help in long-term financial planning. So here, we define long-term as a period above what? 1 year. And then for the short-term analysis, it's made to study current financial stability, solvency, and profitability of a concern. So this analysis helps to know whether the firm will have sufficient funds to meet its short-term requirement. That is help in working capital analysis. So here, we define short-term as a period of less than a year. Hello?
Madam, we are following.
Yo, Abochi, Albert, what are the 3 types of analysis? If you are following, what are the 3 types of analysis? Albert Kwame Abochi.
Madam, there are analysis according to material, according to method and objectives.
According to material what? Material use.
According to material use. According to method.
Okay.
And according to objectives.
According to objective. Thank you. Monica. Where is Monica? Mumuni Emmanuel. Nashiru Al Hassan.
Yes, madam.
Can you explain analysis according to material use for us? Who will help him? Patrick.
Material is used, and then that one is Excel and
Okay. Thank you, Nashiru. Who will explain the next one for us? According to method of operation. Sule. Hello. If you don't talk, we'll not proceed though. It's a haku. Hello?
Yes, madam, we can hear you.
I'm asking a question. It's not about you hearing
Madam,
me.
I thought you mentioned Sule. That's why we keep this.
So Ibrahim, kindly help Sule.
Yes, madam. Madam, was the analysis according to method of operation? You made mention of two types, that we have horizontal analysis and vertical analysis.
Okay. So what's the difference between horizontal analysis and vertical analysis?
Madam, please, the horizontal analysis.
Madam.
Is when the financial statement of the company is for is interpreted and compared between these years of the same organization.
Okay. And then the vertical one?
The vertical one is one when this thing has been on the financial statement of the organization for one period.
Ibrahim.
Yes, madam.
For one period is what?
It's analyzed vertically.
Okay, thank you. Who explained the last one? Kwabena, is he here? He has not spoken today. Kwabena. Mumuni Emmanuel.
Yes, madam.
So yes, okay, Achia is. Achia Kwabena.
Madam.
Can you explain the third one?
Madam, the third one is according to the objectives of the organization. And it can be either long term or short term.
You from which study center?
Botek, please.
Botek. Hey, so yeah, here I've been mentioning your name, sir. I'll be mentioning your name going forward. Thank you.
You're welcome.
Okay, so we are moving on to importance of analysis and interpretation. So the first stakeholder here is management. So how is analysis and interpretation important for management? So it will help them with proper execution of managerial functions, their needs. Management needs correct and reliable information. In the absence of this, management can neither plan nor fulfill other function. For efficient use of capital employed, that's for determination of credit standard, for improving financial position, and the guidance of financial statements is necessary. Also, well-drawn and properly constructed financial statements have great help in policy formulation. So all these things is not just important for external stakeholders, but it's important for internal stakeholders as well. It helps in analysis of net results of different activities and the efficiency of employees concerned with those activities. Then again, financial statements can help management measure the effectiveness of its own policies to determine the ability of adopting new policies and procedures and measure the results of their managerial effort. Also, they can study the relative efficiency and weakness of different departments and find the way to overcome the deficiency. It is also important to suppliers. Suppliers are very important to the organizations. Suppliers of trade credits always strive to attract a good number of new traders, and due to tough competitions, suppliers feel that the financial position of an organization must be examined before they sell the goods to the company in question. So in doing that, They check these financial statements to see if the company in question is sound and they can make payments at the right time. So from this analysis, creditors can be able to know the credit worthiness, capacity to pay, the outsiders obligation, and solvency of the firm. It is also important to owners. Owners of the concern are interested to know whether business is being carried on efficiently and the amount invested is efficiently employed from the viewpoint of risk and return. It is obvious that owners will get this information through the financial statements. So an example is here that when UT Bank since 2010 did not provide financial statement to its owners, it means that they will not be able to know how efficient their investments are doing. And this then, because the owners were not knowing how their investment were doing, it led to the financial difficulty in 2017, leading to the takeover of GCB Bank Limited. Takeover by GCB Bank Limited and subsequently delisting from the Ghana Stock Exchange. So they were not transparent to their owners, and it led to them being hostily taken over. It led to hostile takeover. We also have investors. Analysis and interpretation is very important to potential and prospective investors of the company. If they see that the company is doing well, that's the company is maximizing shareholders' wealth, which in turn increases the share price. It attracts more investors. So investors from analysis, we'll be able to know the earning capacity, soundness of dividend policies, the degree of financial growth by analyzing the financial statements. And prospective investors can make investment decisions. So it informs investors. So if any of you here want to invest in a company, you can do analysis of their financial statements. If you see that they are doing well, you can then go ahead to invest. And it's also important to bankers because banks normally most of the times give loans to these companies, and they want to know the standing of the company, to know their financial position, their liquidity position, credit standing, earning capacity, asset distribution, and all that, to know whether the company in question will be able to pay its loan on time. And then it is also important to governments because taxes are very important in a country, and government with the registrar of companies acquires a copy of the company financial statement from every company to assess whether these statements have been prepared and published according to the rules or not. Then again, governments have recently started active participation in economic activities so that they will know the position of the company in taxable income and in net worth, which is available in the financial statement. However, in our country, companies are not providing the annual financial statement to the Registrar General of Companies, and the Registrar General of Companies has also refused to demand same from this. So due to that, most of them evade tax, or they are not paying the amount of tax they actually have to pay. And then the stock exchange analysis and interpretation is important for them because the shares of companies are listed in the stock exchange. Financial statements provide information to share brokers to analyze the operating performance, financial strength, stability, and fixed prices of shares. So listed companies in Ghana are required or obliged by law to publish their financial statement every quarter of the financial year. The Ghana Stock Exchange, in a quest to get more information, instituted the concept of what? Facts behind the figures. And this allows companies who published the quarterly reports to meet investors and regulators to answer some pertinent questions. Another stakeholder that analysis and interpretation is important for is what employees and trade unions. Financial statements provide information to employees and unions about operating performance, wages policies to make ground for claiming bonus and other profit sharing. In light of the takeover of UT and Capital Bank by GCB in 2017, where workers were laid off and jobs lost, it is imperative for employees to be interested in the operational efficiency of the company they are working with, to know whether there will be job security in the foreseeable future. Because in 2017, most of them did not know they will be laid off. It was a shock to many of them. So as an employee, when your company publishes their financial statement, you have to look through to see how it will benefit you in one way or the other. The labor unions can understand the fairness of wages policies, degree of exploitation, goodness of work from what? Analysis and interpretation of financial statement. And let's not forget our customers. This is very important to them because customers need to know the cost structure, credit policy, and profit margin. We'll use the same example again. So in the case of UT Capital Bank, customers should be interested in the management of the affairs of the company and always use the financial statement in computing the distress levels of these companies. If this was done, most customers would have taken prudent decisions before the closure of these banks. This was also the case of Beige in 2018, where customers who saved in fixed-term instruments are finding it difficult to retrieve their monies, and that is the case for Men's Gold as well. And then Research Scholar. Various research institutions and individual researchers have deeper interest in financial records of the concerns operating in the country. They will need financial information to inform teaching and learning in institutions of higher education. This will be true because students trained with this information will end up working with these companies. In your case, most of you are working for this company, so you have to be checking their financial reports. According to Kushret 1972, financial analysts can look through the financial policies used by management and offered constructive suggestions to overcome financial problems. And then we have who? Economists. An economist can also need analysis and interpretation because they can study all the extent of concentration of economic power. They can analyze financial policies and make an option about the pattern of investment. Any question at this point? My people, Achia. Ernest.
Yes, madam.
Anna,
Yes, madam.
please, are you following? Any question? Any contribution?
I'm following, but I don't have any question or any comments at this moment.
Yeah.
Thank you, ma'am.
What about Delegate? Ernest, Anane, Ibrahim? Meaning you are all following.
Yes, madam.
Ibrahim, do you have a question?
No, madam. Not yet, madam.
Then let me ask you a question. So I know you are an employee of an organization. How is analysis and interpretation of a financial statement important to you, Mr. Ibrahim?
Yes, madam. Madam, unfortunately, I'm with the security sector, and it's very important, the financial statement analysis. Normally, one will make a lot of
you are what? You are part of the what? Unity.
security personnel.
Okay.
So normally at my organization, one will make, if the financial statement is very viable,
Okay.
and definitely we will get our bonuses as an employee.
Okay. And as a customer, so those who invest in financial institutions, you have to be concerned with their financial statement. Otherwise, your money can be locked forever. Any other person who will give us a practical example? Joseph. Hello. I'm asking a question. Joseph. How is analysis and interpretation important to you?
Ankara, please bail him out, an accountant.
All right. Madam,
Yes,
let me help.
Example.
Let me help.
Joseph is talking. Anytime I mention his name, he doesn't talk. Is he here? Okay. Sansa, Ankara, I'm listening.
So I'm using myself as a customer.
Okay.
So the financial statement is important to me because I will use the financial statement to know the structure of the company, the credit policy, and then the profit of the
Are you
organization.
reading from the book? I need your own view. I need like a practical experience.
I don't have the book. I don't have a book.
Okay, I'm listening.
I don't have a book. Okay. So that I will be able to make informed decisions.
Okay. So which industry are you looking at? Are you looking at the financial sector or?
Yes, the financial information. I didn't get the question well.
No, we have different companies. So somebody would want to, let's say you're investing in a bank. As a customer, you would be interested in their financial statement because it will affect you in one way or the other. As a prospective investor, maybe you want to invest in Farm Milk Limited. So you'll be interested in their, their financial statement to know whether you should invest in the company or not. Please, are you following? Maybe as an employee of Nestle Ghana Limited, you'll be interested in their financial statement to know whether for the foreseeable future you have job security or not. As the government, none of us is the government here. So as the government will be interested in the financial statement to know how to tax the organization, to know whether Joseph, please, I'm coming, to know whether the organization is paying taxes or not. Hello.
Hi,
so
madam.
who was speaking?
Madam. So this is Joseph. Madam.
Okay, Joseph.
Hello.
I've been calling you.
Yeah, this is Joseph.
Yes, I've been.
Yes, please.
I've been calling you. No response. Why?
Madam, my laptop has an audio challenge. And then if I use my phone too, the network is not very good. Yeah, so I was saying that in my case, can you hear me? Hello?
Yes, I can hear you. Go ahead.
Okay, so I was saying that in my case, I work for Gilbert, Ghana Institute of Linguistics, Literacy, and Bible Translation. So we, as an employee, I'm actually a management staff. So we prepare accounts to the headquarters. And the headquarters now sends the accounts to the donor organization. The donor is Netherlands, Wycliffe Netherlands. Now they are interested in our financials to see the amount they have invested in the last 1 year or last 3 years in order to approve the next phase of our project. So that is what I can say about our financial preparation to our donors, as well as our headquarters supervisors.
So he's
Thank you.
explaining from the view of owners. So Joseph is explaining from the view of owners. So here the Netherlands, whatever, has invested in their company and wants to know their financial standing, to know whether they should go ahead with their investment or to retract it. Any other person? This class that you talk, whether you like it or not. I've seen a new person, Esmond Akidam. Esmond.
Okay. Hello, madam.
Yes, Momoni.
Do you have madam, we've gathered together. We have about 4 people using one laptop to join the class.
So anybody can talk.
And so Mr. Akidem is responding to you. Hello, madam. I'm listening.
Akidem.
Yes, madam.
Okay, so what is your take on it? What's your take on the issue?
To me, I will talk as a customer.
Okay. Hey, nobody is talking as a supplier.
So as a customer,
okay,
I would like to know whether if hello, madam.
I'm listening.
As a customer, I would like to know whether before I put my money into any venture, I'll make any profit or the business that I intend to do, it will continue to exist before I decide what to do.
Okay, thank you, Mr. Akida.
Yes, sir.
Move on to traditional.
So, madam, this is Mumuni.
Okay, Mumuni, madam.
Okay, so I want to act as a supplier for today.
Okay, talk for the suppliers. That they are very important.
Yes, so for the supplier, I will be interested in the financial statement and the position of the institution that I am dealing with.
Okay.
So that I will be able to determine if the returns that I needed, I'll get it. Because if the financial position of the institution is not reliable, if you go and supply them goods, maybe on credit, you might not, they won't be able to pay you back.
Don't pay.
Yeah, so I will be able to know how to transact business with them.
Okay.
Depending on the financial position.
Thank you. Meaning you are all following. So
yes.
let's proceed. Then we will look at analysis.
Madam, please, we have Mr. Sommet too here.
Oh, I have some few slides after we can discuss. Okay. So let me proceed. Okay, thank you. We can also do analysis using the traditional or the modern approaches. So the traditional refers to subject matter of financial statement analysis as a separate branch of study. It is based on basic conceptual analytical framework. It is not applicable in internal decision making. Modern approach of financial statement analysis is broad-based approach that provides a conceptual and analytical framework for financial decision making. It is an integral part of overall management. So the traditional one, it's like a separate branch of entity and it is based on conceptual and analytical framework. But here it's only done through the external approach is applicable for external decision making, not the internal one. But the modern one is broad-based that provides a conceptual and analytical framework for financial decision-making for both internal and external, and it is very important part of overall management. So let's look at the distinction. It will help us understand the difference between the modern approach and the what? Traditional approach. So when we talk of the traditional one, financial analysis is not an integral part of the various disciplines concerned with decision making. Economists and finance experts do not rely on the information reported in the financial statement, and they ignore financial statement analysis. But for the modern approach, financial statement processing system as an information processing designed to generate system relevant information as inputs to the application of various decision-making models. Example, the portfolio selection model, bank lending decision model. Also here, for the traditional approach, the framework within which analytical methods and techniques are developed are not defined appropriately, resulting in lack of direction and progress. For the modern approach, tools and techniques are developed and tested within the well-defined framework of decision theory. For the traditional approach, financial analysis is completely detached from economic theories and models. And then for the modern approach, financial statements is closely connected with economic and financial models. For the traditional approach, statistical tools or techniques are used, but simple mathematical tools like ratio, percentage, averages are applied. For the modern approach, statistical tools and techniques are as well as complicated mathematical models are used. And then the last one, accounting data are conventionally reported in financial statements. And then for the modern approach here, reported accounting data, unreported accounting data, such as market value of assets and non-accounting data, share prices are taken into consideration. Hello.
Yeah, yes, madam. How are you? Following.
Yeah, following. What did you hear?
Madam, you just recently mentioned the differences between the traditional approach and the modern approach of the financial statement analysis.
Mm-hmm.
And
And what did I say? Hello.
Yes, madam.
Hello.
Yeah, him. Hello.
Yes, madam.
So the traditional approach is more of like a traditional or an old school way of studying data, and it's more qualitatively inclined. You don't use strict analytical or statistical tools. But for the modern approach is the novel way of using computers and technologies to analyze financial statements. So it is more modernized. So with a modern approach, you can use maybe artificial intelligence to analyze what financial statements. But for the traditional approach, that's the one you do in your exams and all that, where you'll be using ratios, comparative analysis, and all that. Please, you get a distinction.
Yes, madam.
So for the traditional,
Madam, no. Madam, for my side, no.
So the traditional ones, the ones you've been taught over and over, the ratio analysis, the acid test ratio, the what are the names? Total assets, debt to equity, and all that. They are traditional ways of doing it. You don't use any complex statistical tool. But for the modern approaches, they use advanced technology, AI. So you can do analysis of maybe different or multiple companies at the same time to know who is doing well. When you use the modern approach, you can take, let's say, a particular industry and analyze them at the same time. But for the traditional one, you have to do it one. It's more archaic than the modern type. Momoni, is it helping?
Yes, sir.
Or
Yes.
is it
Yes,
helping?
yes.
So with the modern type, you can use big data. When we say big data, it's like data on the different types of companies. So you can do bulk analysis at a time, at a go. Please, you get it. But the traditional approach is the one you do in exams, like the asset test ratio, debt to equity. How can you be sitting down using the traditional approach to be calculating, doing analysis, when we have modern and novel approaches that is more efficient and faster? So with the differences, we are saying that here, lack of direction and progress. You have to, when you are doing the interpretation, it's more difficult with the traditional approach than the modern approach. And they are saying that the portfolio selection model. So we have like how shall I say it, a system or a model that makes it easier to group a portfolio of maybe investment, instead of analyzing the companies one using the traditional model to see who is doing what. The modern approach, you can use modern technology to get a portfolio selection well. And then bank lending decision model. So the IT guys can make a model for a particular company to know how they'll do their bank lending decision. So this bank lending model will look at the credit worthiness of the company. So they have it all written down. So at a go, they will know whether they should lend money to the company or not. But for the traditional one, you are now coming to sit down and calculate. Please, you get my explanation, or I'm confusing you? Hello, my people.
Madam, we are okay.
Yeah, okay. Mumuni, you asked the question. Are you okay?
Yes, please, I'm okay.
Yeah, okay. So this brings us to the end of our class. So when we started, I took you through the overview of financial statements. We looked at the tools for analyzing financial statements. We looked at the preliminary analysis, where we looked at economic, industry, and company analysis. And then we talked about the Porter's 5 forces under the industry analysis. For the company analysis, we also looked at this to see how viable a company is. We understood what a financial statement is in an annual report, and most of you were able to distinguish between what a financial statement is and what an annual report is. And at the end, we concluded that a financial statement can be found in an annual report. We looked at things that can be found in the financial statements, what is found in the footnotes, and all that. What again did we look at? We looked at the nature of financial statements, as well as what the limitation of what financial statements. We looked at the distinction between analysis and interpretation. interpretation, of which I know all, and you cannot do interpretation without analysis. They go hand in hand. We looked at the type of analysis where we have the three types: analysis according to material use, according to method of operation, and according to objective, of which you all understand. We looked at how important analysis and interpretation is to the various stakeholders of an organization. And then we looked at the traditional and the modern approaches to analysis, where we looked at the distinction between the traditional and the modern approaches to analysis. My name is Elsie Abnadonto, and thank you once again for joining the class. See you again next week, same time. Yes, Joseph. Any question, contribution? We have two Josephs.
Yes, madam. Hello.
Yes. Yes.
Yes, it's the same Joseph, madam. I'm using a phone now. I humble appeal to you, your humble good self, madam. I want to suggest, if it is okay with you, by your time, that this class be shifted to Sunday. Yes, madam. I'm saying that. Yes, madam. Can you hear me? Yes. I'm saying that I'm appealing to you and the class.
Yes.
My colleagues, that this particular class be shifted to Sunday, if it is okay by you and my colleagues.
Please, it's not possible.
Thank you, madam.
It's not favorable to me. Thank you.
Okay.
So we are done
All right.
with the class. We'll meet again same time next week. Have a lovely day. The program reps, who are the program reps for the various centers? Kindly contact me.
Okay, madam.
My number has been given to you. So kindly contact me so that I can give you the slides. Please use the slides hand in hand with your models. Okay. Thank you very much. Have a lovely weekend.
Thank you for your time.